For many of you guys, a few years into your personal finance and investing journeys, you may have already reached the $100,000 mark as far as investable assets go. And I want to pause for a moment here to congratulate you on that effort. Many people throughout their entire lives never manage to save even $1 million throughout their working career. This leaves them in such a negative position when they get into retirement where they need to rely on loans against their house, reverse mortgages, Social Security, cutting their expenses, not going on vacations with their family or grandchildren as they approach those older ages in their lifetime. And it creates a really negative outcome and experience as far as people go as they get older into their lives. So for the fact that you reached $100,000, you've made a considerable return into the stock market. You've established certain habits which are going to allow you to thrive and grow and succeed into the future. And you've done a great job. But that does bring up the concern about how do you continue to invest as your balances in your accounts increase. And this is where alternative investments can become a consideration, a potential option, but not necessarily the only way to further diversify your portfolio outside of the general stock market. So to take a step back, let's revisit the first $100,000, how most people typically approach getting there. People will typically reach their first $100,000 by establishing better financial habits, those being cutting expenses, increasing savings rates, and paying down debt until they can establish an emergency fund, typically associated with 3 to 6 months of emergency reserves. Say you lost your job, can you afford to pay all your bills for 3 to 6 months while you try to find the next opportunity to gain income? And then secondarily, they pay down high interest debt. As an example, you may have a credit card that you racked up a balance for in college or due to some life expense or situation, and in that situation you would be paying down that interest rate and any outstanding debt against those credit cards. Now, people typically invest into large, broad, sweeping index funds like the S&P 500, the NASDAQ, the Dow Jones, etc. And these can provide a, generally speaking, positive and good rate of return over the long term. A fun stat that I like to tell people is that since 1915, the S&P 500 has returned an average of 7 to 10%, 7 if you aren't reinvesting dividends, and 10% if you are reinvesting dividends. And over a lifetime of 40 to 60 years invested into the markets, you can see considerable returns. This is why people who say the baby boomers didn't do much for retirement, I think, are wrong. They saved, they invested, and they benefited from the growth of the American economy. But while a 7 to 10% return is positive and can help you reach your longer-term financial goals, there are other asset classes out there which can provide uncorrelated, potentially higher and diversified returns as opposed to just a generalized stock market. When people think about diversification, they typically think in terms of sector, market cap, as well as industry. So an example could be if you have a lot of shares from your employee stock purchase plan for a financial services company, or industrials, if you work for Caterpillar as an example, you have very concentrated asset allocation within those specific industries and companies. Whereas when people think of diversification, they want to start purchasing stocks in other industries, so consumer cyclicals, industrials, materials, financial services, tech, communication services, etc. And the goal behind doing so is that when one asset class does well, other ones will do poorly, but on a net by net average, when you look across the portfolio over a prolonged period of time, you'll be getting that 7 to 10% return that we just spoke on. Now, once you reach the $100,000 mark, in my eyes, this is where you can begin to diversify your assets outside of just the stock market and cash for your emergency fund savings. And there's a lot of options out there, some of which are available to non-accredited investors, which will be the purview of today's video, and some of which are available for only accredited investors. And to briefly touch on that item, being an accredited investor means that you have over $1 million of assets available to be invested, or that you have an annual income for the past 3 years of about $200,000. And for most people, this is not something that is going to be a reality that they'll be able to reach, especially early on in their journey. Of course, that's subject to change as you increase your income, gain more skills, and have more assets invested into the marketplace. But that point still stands where there's only so many opportunities for non-accredited investors that are out there as far as the alternative investment assets are concerned. But I do want to get into what some of those are to give you an idea, a broad overview about how you may be able to diversify your portfolio further than you currently have today. And to get into the details, let's talk firstly about real estate crowdfunding. Real estate crowdfunding is essentially a platform which allows a pool of investors to put their money together to crowdfund real estate opportunities. An example could be you have an investor who wants to buy and flip a home, say in a different state than you live. The property itself costs about $1 million, and they'll go to a platform like Fundrise or Ground Floor and request a pool of funds or a loan to actually purchase and do whatever they intended to do with that property. Those services, including Ground Floor, which I highly recommend if you're looking into getting into hard money lending for real estate, or Fundrise, which actually buys, manages, and rents out properties over the long term in a private e-REIT sector, will take the pool of money that investors will give them, issue loans out to the person trying to buy that $1 million home. Accordingly, that person will pay interest on the loan, and that interest paid on the loan to you as an investor becomes either dividend distributions or monthly rental income, depending on the structure of that real estate opportunity. And it's a really interesting opportunity for someone who wants to get involved into the real estate sector without actually having to purchase real estate. While real estate is a very powerful asset class to be in, especially in terms of tax deductibility and write-offs, the longer term management and facilitation of actually owning those assets is very difficult. And you can imagine, simply put, why. Well, if I want to buy real estate, I likely am going to need to get a mortgage. In that regard, I'll need to have recurring cash flow and income to be able to qualify for underwriting. Of course, there's third-party vendor fees for issuing said loan as well, including the title fee, appraisal, insurance, recording, taxes in specific states like New York and Florida. And then, of course, you need to manage the renting out of the property and who wants to deal with tenants, especially in today's era where the government can just snap their fingers and people don't have to pay their rent anymore. But when you do it through a service like Ground Floor or Fundrise, an alternative real estate crowdfunding platform, many of the downsides associated with real estate are going to be managed by the end platform. Of course, you'll be paying them a management fee, but to me, the time freed up by not having to deal with some of the negative considerations of real estate can be worthwhile to have someone else manage, and then I pay a fee for them to do so. The returns that you can seek from real estate crowdfunding are going to be wide and varied depending on where you're going to put those assets. Fundrise has accounts and portfolios that can yield you between 5 and 7% rental income on a monthly basis. Ground Floor, being a little bit further out into the risk spectrum, can offer yields up to 14.5% depending on the risk of the opportunity in question. It's very important to understand the local real estate market in which you're going to be purchasing opportunities and investing within, especially when considering a crowdfunding platform like Fundrise or Ground Floor, albeit it's something that I do like a lot, and I highly recommend that you check it out. And please let me know in the comments if you have any questions or you want a deeper dive video on this exact topic. Now, to get into the next alternative investment opportunity that is available, let's speak on peer-to-peer lending. Peer-to-peer lending, simply short, is where individuals who need a short-term or a medium-term loan will go to a platform like Lending Club, Prosper. There's a few ones in the crypto space, which of course went under during 2021, but you get the concept here, where they go to this platform seeking a short-term loan rather than the bank putting up the capital, which is going to make up the capital used for the denomination of said loan. You as an investor have the opportunity, alongside numerous others, to crowdfund the short-term loans for these other individuals. Now, you can think of peer-to-peer lending in a similar way as you would fixed income, in so much as that rather than lending money to a local government who's going to pay you back principal and interest on a monthly basis and then eventually back the maturity of the bond, they'll pay back your initial principal investment. Peer-to-peer lending is you lending to an individual rather than a company or municipal or federal government. The returns are also uncorrelated to the stock market, as they are a debt obligation from one individual, meaning the person you're lending to yourself. The yields are, generally speaking, a little bit higher than fixed income, lower than that of credit cards, as many people will use these short-term loans to consolidate higher interest rate debt into a facility that will be the one that you're actually putting your money into. The returns are pretty good. I would say they can range between 5 to 15% depending on the platform, risk, and creditworthiness of the borrower in question. But the consideration that you need to have in mind when you're issuing short-term peer-to-peer loans is that there's repayment risk. There's a reason why this individual is seeking the capital. There's a reason why they don't have the money on hand to pay down any outstanding debts that they have. They're coming to this platform, etc., for the purpose of consolidating or paying down debt, ideally at a lower interest rate that they're already paying, but you have to consider the financial financial ability of repayment for the person that you're lending money to. Otherwise, you can imagine that an uncollateralized loan, meaning there's nothing you can liquidate if they don't pay you back, you're at a risk of losing your initial investment. So big consideration there. A lot of platforms out there as well, so do your due diligence. Do not get involved in any peer-to-peer lending unless you fully understand the risks involved before putting in your first dollar. Now, another option that's available for someone looking to get into the alternative investment space is venture capital, angel investing, and private equity. And while many of the opportunities in this space are limited to accredited investors, going back earlier to what we were saying, someone with $200,000 of annual income for the past 3 years, or someone with $1 million of assets available to be invested, there are platforms that are out there today which allow you to get into the venture capital and angel investing space without being an accredited investor. I think Sweater is a really good example. They invest in very early stage, seed stage venture capital opportunities. For a little bit of a debrief on what seed stage is, you can imagine that when a company is initially starting off, they have a concept, but they have no funding, they'll go to institutional investors, or in the case of Sweater, to that platform to collaborate and to get funds for an initial investment. And in lieu of getting that capital, they will give shares of their company to their investors. And the goal is over time that company will increase its future cash flows, grow its profit margins and profit and consumer base, and then eventually those shares will be worth more than they were originally at the time of the initial investment, and then sales can take place to a broader but still private market to actually capture the capital gains of the increase in value of that company. So when you're investing in those kind of platforms, the thing that a lot of the individuals that I've spoken to are able to do when they invest in private equity, venture capital, etc., is they understand that risking much of their balance sheet in a single opportunity is likely going to be a poor idea, as the potential for returns for these early stage companies is massive. You can think about investing in Steve Jobs when he was a young 20, 30 something in his garage with his buddy coding on the computers. Even putting $1,000 into that opportunity may seem like an outlandish and crazy thing to do, but then those who had actually taken that risk were seen with sizable and immense returns, making millions if not billions of dollars. Whereas at the same time of Steve Jobs and his buddy in the garage coding and forming Apple, there were hundreds, if not thousands, if not hundreds of thousands of other companies that were doing similar things, had similar prospects to growth and future returns, albeit their company never took off, or did, and they made a mistake and they failed. So when you're investing in these kinds of opportunities in the venture capital and private side of the markets, you need to not only manage your risk allocation, so don't have too much of your overall balance sheet invested into those opportunities, but you need to invest in multiple opportunities. So if you're going to invest in a single private equity opportunity or venture capital fund, you need to be investing in 10 to 15 other ones. Why is that? Because in the same way that we diversify across industries in the stock market, we should diversify across businesses within the private sector. You only need one to do very well for it to offset losses in any of the other opportunities that you got into. Imagine you had $100 into 10 different venture capital funds, 9 of which went to zero, 1 of which went to $100,000. Well, I don't care if I lost $900, 9 times 100 initial investment for those that failed. I just made $100,000 in the one that went well. So big consideration there. Not all these opportunities are going to be available to you unless you are an accredited investor, but some of which are, and they can be found on places like Sweater. ARK has a new venture capital fund, which is available as well. So some things to consider in that regard as well. Now, the final alternative investment that I want to talk about, or actually not the final, the second to final, is going to be cryptocurrency and blockchain technology. Now, cryptocurrency is a new asset class that came about after the advent of 2008, albeit the underlying blockchain technology has been around for decades prior to then, where essentially you have either what could be considered an unregistered security or a commodity, and I can break it down in more detail in just a moment how you can differentiate between the two of those in the space, where you can actually invest in within that company or security or commodity for the prospect of a future return into the future. Now, the cryptocurrency industry, being as unregulated as it is today, poses some substantial risk for investors who aren't necessarily too familiar with the space. You can think of the unwinding of companies like FTX, Terra Luna, BlockFi, because there's very poor and limited risk management as well as disclosures within the space as well. So as a starting comment, one of the recommendations that I would give for anyone looking to get involved into the cryptocurrency industry is to invest directly into tokens or coins themselves, rather than investing and having those coins be on platforms which are offering you some type of sale or yield or income, etc. Why is that? Because you can have direct hard custody control over the cryptocurrency assets that you have, and rather than leaving them on an exchange or trusting them to some kind of bank or hedge fund to create some kind of yield for you, you know that when you sell those assets, you'll be selling it at whatever the market price is determined for it at that time, rather than some rate of return which is promised upon you by some third-party institution. The thing about cryptocurrency is that it's designed to be decentralized and trustless, so why would you trust a third party with your assets in a space where that would be antithetical to do so? Now, to return to the topic of unregistered securities versus commodities, let's start off with commodities and cryptocurrency. And to begin, a commodity is an asset which has a fixed supply. Its price is determined by an open market, meaning what someone else is willing to buy or sell it for. The price is determined at random by that flow over time. In addition to the fact that there is active market participation for determining said price, there's someone else who's willing to buy said commodity. Gold is a commodity, so in the same way that people find gold to be valuable, its price can go up or down over time depending on what people are willing to pay for it. And there are cryptocurrencies which are designed in a very similar way to how gold functions in the economy today. You can think of assets like Bitcoin with a 21 million hard cap supply. There's only and ever going to be 21 million Bitcoin that will ever be in existence. Litecoin, a modification of the underlying Bitcoin code, acts in a very similar fashion. If you can think of Bitcoin as gold, you can think of Litecoin as silver. And then there's unregistered securities, where a security is a company, technology, schema of some sorts, which intends to profit off of the work and behavior of other individuals. An example of this could be Ethereum. In my eyes, Ethereum is a security, and Ethereum is a security because it is an underlying technology and platform which offers individual investors the opportunity for a potential return based on the work of other people. And what is that work that they're doing? Well, they're either staking, or meaning having their coins locked up within a set period of time to validate and benefit the network. In return, they get staking rewards or further Ethereum for that work. And there are smart contracts which can be used to buy, sell, lend, leverage other crypto assets as well, meaning other people's participation within the network and pay those individual investors who actually put money into Ethereum. And in that regard, it's a security as well. And I would say, to be candid, 95% of the cryptocurrency industry is a scam, are unvetted, untested technologies which over the long course of time are not going to exist into perpetuity. You could think of things like Dogecoin along these lines, purely speculative assets that you're buying and selling for the purpose of having someone else pay you more than you initially bought into it. However, I do see the cryptocurrency space as one of the most untapped and profitable industries and sectors that you can get involved in. As an example, Bitcoin has outperformed the S&P 500 since inception on an annualized basis when you're looking at risk-adjusted returns, and I do believe that a small allocation to your portfolio for high-quality, potentially profitable cryptocurrency projects is worthwhile to have within your balance sheet. A lot of considerations to be made here. Certainly do not do anything in relation to the cryptocurrency space until you talk to a financial advisor and you can better understand the risks and rewards. And in short, if you haven't read the white paper for the coin, should you ever invest into it? In my opinion, no. But do what you want. Now, the final opportunity that I want to talk to you about today is going to be fine art and collectibles. And this is a very interesting alternative investment because it's not cash flowing, meaning it's not going to be generating you monthly income on a recurring basis. Rather, you're actually going to be purchasing a real hard asset for the purpose of selling it to someone else later on down the line. And rather than buying things like sugarcane or oil, which is going to be in the commodities market, which is very difficult to time unless you're very good at technical analysis and macroeconomic analysis, the fun thing about collectibles and fine art is that for certain types of those items, there's always going to be a marketplace for someone to buy them later on down the line. You could think of the Mona Lisa. The Mona Lisa has been around for hundreds of years. Over time, its value has gone up as its allure and notoriety within society have also increased, and accordingly, whomever is the owner of the Mona Lisa has profited handsomely for their beneficial ownership over that asset over the long term. Fine art is difficult though, because in the same way that I might think the Mona Lisa is beautiful and I'll pay as much money as I have into my name to have ownership of it, other people may not have the same sentiments as to a piece of art that you would. So you need to think critically about the type and the artist of fine art that you're going to be purchasing part within, as while it can give you outsized returns compared to the S&P 500 or the stock market, there does need to be an active marketplace and someone willing to purchase that art for a higher price for you to actually get a return. Otherwise, you bought a painting, but you could have gone to Goodwill and bought a painting there for it to do the same thing, i.e. nothing for your portfolio, nothing for your net worth. I am personally not invested into fine art. The only meaningful way that I've found to actually get participation within the sector is through a service called Masterworks, where they have essentially fractionalized pieces of art which you can buy and sell on a secondary market and hope to gain a profit from. How Masterworks works is that they will purchase a piece of art via an LLC or an entity structure, and then when you go onto their platform, you're not actually purchasing the art itself, you're purchasing fractions, shares of that company, which then gives you a beneficial ownership or a percentage ownership over said piece of art. Eventually, when that art is sold, the LLC is liquidated, and then you can sell your shares for its corresponding value of whatever that art was sold for. Certainly an option, one that I would not recommend you get into, at least until you hit the $500,000 mark or $1 million mark, but there's a lot of tax benefits and efficiencies which can be gained from investing in fine art, which may not be applicable for other types of investments. One example could be depreciation, another example could be donating your art or shares of art into a charity, which can be a tax deduction in your own personal name, but of course if you have ownership and control of the charity, did you ever really sell or donate that piece of art? That's a different question for the IRS, but not something that I'm going to talk to you about today, as I am not your tax advisor. I just hate paying taxes. So on that note, I kind of wrapped up the 5 best sources of alternative investments. To reiterate, for the purview of the closing out of this video, you have real estate crowdfunding, real estate, you have peer-to-peer lending, you have venture capital and angel investing, cryptocurrencies and blockchain technologies, fine art and collectibles, all of which I think are a really good place to begin diversifying your portfolio further than just the stock market and cash. One thing I did not touch on is proper sizing for each one of these opportunities. My take is that you should have no more than 5% of your portfolio within any single asset class, unless it is stocks or cash, as those are, generally speaking, if you're doing it the correct way, diversified, and can give you a beneficial expected return over a long period of time. But just given some of the risks that I had spoken on today about fine art, peer-to-peer lending, real estate, angel investing, venture capital, etc., I would recommend no more of your balance sheet be put into any one of these opportunities. So to quantify this in more detail, let's say you have $100,000, you should put no more than 5% into art, or no more than 5% into peer-to-peer lending, or no more than 5% into your real estate crowdfunding. And for that reason, you can continue to benefit from the opportunities of diversification, meaning uncorrelated returns, outsized returns, depending on the risk profile of what you're putting your money into, but you can still benefit from risk sizing in the event that some of the negative aspects of some of the investments turns out in the longer term. Now, I hope you guys enjoyed this video. There's a link to a few of these platforms that I had mentioned in the comments as well as the description of this video, so be sure to check them out if you're interested in diversifying your balance sheet in a further way than you have before. I want to know that you guys are awesome. I really appreciate you checking out these videos. Be sure to like, share, and subscribe. Let me know your thoughts. And at the end of the day, this channel is for you guys and for me to talk about the stock market, personal and self-development. So if you have anything you want me in specific to touch on outside of my rambling and ranting that I typically do on a day-to-day basis, be sure to let me know and I will address that shortly. On that note, take care of yourself. 4th of July is coming up soon, so if you are an American, eat a burger and hot dog, have a beer for me, and we will touch base soon. Bye now.